It's all hands on deck at the Fed as payrolls disappoint. Is taper talk over? Will there be a fiscal response? And why did bonds dump? Answer those questions and more on today's show. I'm your host, Steven Van Metre, and thanks for joining me today. And we have a lot to talk about. I'm really excited about today's show, but we first must address the big issue. I actually got something right. I took the under, and so did many of you. 1,300 of you responded to my Twitter poll and took the under. And how did we know that the probabilities lie in the midst of this payroll report? Well, let me show you what the reasoning was. The first one was this chart here from Zero Hedge, a chart I've not seen anyone else put together, showing total claims across all unemployment statistics unchanged for 4 weeks. So that was a big tell. I mean, you would think if there was a lot of hiring, people would be going off unemployment. I mean, the odds that you would see people that weren't on unemployment go to get those jobs versus people that were on unemployment knowing it was expiring soon, it doesn't make a lot of sense, and it didn't. And so that was one reason. The other one was the ISM manufacturing data kind of gave me a hint of that. We'll look at the services sector today, but we've got to talk about this disaster of a payroll report and what it means from a policy response. Because if you start looking at the Fed's perspective from their lens, what are their two policy goals? Price stability, which we can all laugh about, and the second one is maximum employment. But what happens when monetary policy does not yield maximum employment? What is left? Is there going to be now more fiscal response? What's going to happen with the taper? Let's get into the data, but just for some comic relief, I have to show you this first. And this one comes from the New York Fed of all places. Now, when you want a good response and you want people to feel good about the economy, well, you make sure the numbers go up. But all of a sudden, the New York Fed, which has what they call a Nowcast, is used to predict GDP, and so suddenly it's been suspended. The uncertainty around the pandemic, which is amazing, that's been going on for over a year, and consequent volatility in the data, which also has been going on, have posed a number of challenges to the Nowcast model. Therefore, we've decided to suspend the publication of Nowcast while we continue to work on some other reasons to make sure it just goes up, because it really is what we're talking about here, is all of a sudden the wheels are coming off the bus. And this is happening at one of the most worst times for the Fed. Let's look at the situation. You have this big payroll miss. What are the numbers? Well, that's right. We got to talk about what those numbers were. Nonfarm payroll, 750,000 expected, 235,000 jobs created. Now, granted, we did see an upward revision from last month, so another 100,000 jobs. So we'll just say this was 335 from the Bureau of Labor Statistics. But what's happening on Labor Day? Of all things, Labor Day, it's called, hi, thanks, labor. By the way, the unemployment benefits are gone. And now all of a sudden you have an issue where there isn't going to be the demand from government stimulus and to consumers to drive the economy forward. And all of a sudden, what are we seeing from payrolls last month? This should have been a big number. What were some of the Fed speakers talking about? Now, mind you, this was not Jerome Powell. What were they talking about over the last month or so? If we see another 800 to 1 million payrolls, we're going to start pushing the board to taper. And that was all the talk. Taper, 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 taper. It's fairly safe to say, because we broke down Jerome Powell's Jackson Hole speech. And you remember, I pointed out, he's saying, look, you may be getting too far ahead of yourself, board members, a little too far ahead. And sure enough, bingo, right on the money, a dud of a report, taper now goes off the table. There's no way they can pull this off. Let's take a look at the other data and see if there's some good news in this report. And there certainly is some good news. Let's take a look at average hourly earnings, up 0.6%, bringing the year-over-year rate of change up to 4.3%. Now, this was cited as some of the reasons the bond market sold off. I don't think that's exactly it. We'll get to my opinions on that here momentarily. But now there's this view that higher wages are magically going to create inflation because there's 12 million people still on unemployment. See, I'll show you 12 million people. We haven't even got to this report yet in today's show, but here it is, almost 12.2 million on some form of unemployment. And the idea is that these people are going to go look for jobs starting, well, really soon. And employers are going to be on their hands and knees begging to please come work for us. We'll pay you any amount of money. It's the supply and demand components, my friends. That's what it comes down to. When all big supply of workers comes back into the market, what are employers going to say? You want a job now, do you? Well, I think you're going to be working for this pay, not the pay that you could have had if you came back to work a couple months ago. It's a supply and demand issue. As supply of labor comes back in the market, puts downward pressure on wages. And of course, some of them may say, I'm not going to work for that cheap. Great. They're also not going to have much of an income either, because 7.5 million of those people, their income should be going to zero. Not only losing their federal benefits, losing their state benefits as well. And for those who are working, well, average weekly hours remains high at 34.7 hours. Usually the number is closer to 34. So those who are working are seeing their wages go up. They're seeing their hours stay up. So that's good news. Now, where was the breakdown in jobs? Well, we've got this wonderful chart here, and it's not exactly where we would think it is. So in the pink, that was last month. So you see leisure and hospitality just drove all of the payroll gains other than government, and black is this month. So what are we seeing? Professional business services driving number one in the list, transportation and warehousing. Well, we know there's a demand there because we see that in the factory surveys where they're saying, look, we got these long supplier delivery times. Manufacturing hiring a little bit, but we know that was last month. Going forward, what did we just see from the ISM? That they're not looking to really hire. Other services, education, with schools getting back in session, makes sense. But look at down here, mining and logging. Those are good paying jobs, hardly anything created. Wholesale trade, nothing. Leisure and hospitality, nothing. Construction, which is running at, if we just looked at it, a 9% year-over-year growth rate, not really hiring. Temporary help. So even employers that are saying, hey, well, we can hire temporary help, those services that provide temporary help, they laid off. Now, does that make sense to you that if there was this demand for labor, that the firms that provide labor, temporary help, why would they lay off? Government laid down in retail trade. And, we hear about all this pent-up demand, and you can see it in the retail trade hiring. Why would retail trade be sending people home if there was all this demand? Because the demand is waning. We're seeing that already in the consumer sentiment data. We're starting to see retail sales roll over, and now we can kind of almost predict where retail sales is headed when we get that report later this month. Let's get back into this data. What do we have here? Oh, yes, hourly earnings. There it is. You can see we already talked about this at 4.3, but it's starting to plateau a bit. So be curious to see where this goes, if it can sustain its increase. How about the labor force participation rate? Probably one of the most important pieces in the Nonfarm payroll report is the participation rate, because this tells you the percentage of people that are participating of the people who can in the workforce. It's at 61.7%. So how do you get involved in that number? Well, either you have a job or you're looking for a job. Otherwise, you can subtract off from 100 and you can find all of the people that are eligible, age eligible to work according to the government, but are choosing not to work for whatever reason. Now, the labor force participation rate is really interesting to me, because if you invert it against the monetary base, which is mostly made up of those reserve assets that are created by QE that I've inverted here on this chart, what you can see is quantitative easing is tightening conditions not only in the financial sector, but potentially in the labor market. And you see this beautiful relationship between the two, suggesting, and we're going to see this in the services when we get to the ISM services data today, what we're going to see is it's possible there's going to be a big dropout in the labor force because there aren't jobs there for them, despite the 10 million postings. Now, on the subject of that 10 million job postings, keep in mind, if you go to a job fair and you speak to someone there about a job, that counts as a job opening. So if that recruiter or that employer talks to 100 people about the same job, And the government counts it as 100 job openings. So keep this in mind that if indeed the participation rate crashes lower, we have a major problem on our hand. Now, what did the market like out of this report other than average hourly earnings? Well, loved the unemployment rate dropping to 5.2%. That seems a bit ridiculous, but the market still loved it nonetheless. Let's back up to yesterday's data because we need to get into that. Some very interesting things here. Let's start out with all car sales and truck sales. And for that, we go way over here. Total vehicle sales tanking down to 13 million units. Now, there's two sides of the story. There's a side that says, well, that's because there aren't many vehicles on in dealer lots. That's correct. Some of them saying it's because prices are too high. That is certainly a factor. And the other one is that there isn't much demand left because consumers in the survey data are saying it's a terrible time to buy a car. Not to mention, many of them did in the last 18 months. So you're seeing total vehicle sales fall. Look at car sales are almost back near their pandemic lows, which is incredible. And even truck sales, which has generally been fairly immune to a lot of things, continues to fall and is now, getting near its pandemic lows, showing that there's a lack of demand for vehicle sales, which is very interesting. We need to look at the unemployment claims. So we'll head over to the Department of Labor. It's slowing down to 340,000 new claims. Now, in a healthy economy, which we need to discuss here, if you have 340,000 claims, that's right about where you would get a non-farm payroll, around 233,000 jobs. There's something to those numbers that when you get that many new claims, you have that few jobs created. So at the current rate, we can actually have a prediction that the next month's payroll report is going to be equally disappointing. How do we know that? Well, because payroll reports are run not quite from about mid-month to mid-month. They need a couple weeks to run the numbers, so they're not, a full actual calendar month, even though they're reported as that. So we're already 2 weeks into this recent report, and claims have been running up in that 300,000 range, suggesting that, of course, we're going to have problems with the next report. So we'll want to keep an eye on that number. We already saw that 12 million number, but what are some other evidence that perhaps the economy is peaking out? That's the import and export number. So look at exports. Went from 210 billion to 212, almost 13 billion. So it's telling you the economy is slowing down as exports look to peak. Now let's see if we can pull this up while we're looking at it, and let's just see. It's on a good trajectory. Perhaps it is back where it was before, and that could be an indication it's slowing down. But look at imports, because the U.S. is a heavily based on imports. And when the U.S. economy is growing, you want to see imports growing. We're the largest importing country in the world, so you want to see imports growing, and they fell slightly from 283.3 to 282.9 billion. So it's telling you that despite all this claims, which it's legitimate, there are shelves that are empty, but when you see imports slowing down and you have 44 container ships sitting at the port of Los Angeles, it's telling you that where imports are slowing, the U.S. economy is slowing, because perhaps we may have enough inventory that's yet to get to the shelves to meet demand. And that is a huge problem. You really want to see in the U.S. in particular those import numbers growing. The export numbers perhaps tell you that the dollar is strengthening a little bit, and we are seeing it, as we've seen the dollar bottom out and move a little bit higher. Let's move into the final durable goods orders. Excluding defense, down 1.1%. Factory orders for July up 0.4%. Excluding transportation, up 0.8%. So let's now get into some of this other story, is what is driving perhaps the bond market. As part of the story, we can now safely assume the taper from talk from the Fed is going to get squelched. And if not, they're going to put it on hold and say, well, we're going to give it a couple more months. And perhaps now you'll hear them talk into next year. But keep in mind, Powell's job is up in February. They don't wait till the last minute to notify a Fed chair he's out. So at this point, Howell looks like he's in, and this is playing well into his hand. Now the question becomes what about fiscal? What about a fiscal response? Is there going to be a fiscal response? Well, let's go and see what U.S. Senator Manchin had to say, and he wants a pause in the talk for the $3.5 trillion spending bill. Now, I want to give you there's two sides to the story. There is the economic side and there's political side. So let's address what the political side here is, because we know Manchin wasn't a big supporter of this. Then he kind of became a supporter of it. And now all of a sudden he's not. And you'll see in the article, he's saying, no, this is going to be an issue of inflation. I want to give you the political side so you can understand this. When a sitting president has a very high approval rating, what you'll see is Congress as a whole, particularly those who are in the middle, maybe on the fence, will lean toward what the president wants to do. It's just no different than having the most popular kid in school be your friend. Now, maybe you were the most popular kid in school and you probably had people that wanted to be your friend because their popularity got tied to being around you. And so the same idea here happens with Congress. When a president has a strong approval rating, they're more likely to go along with what they want. They want to be part of that success story. Because remember, what is a politician's two goals? One is to get reelected. Number two is to get reelected. That's it. The rest of it doesn't matter. As long as number two occurs after number one, they're good. Now, on the reverse, when you see approval ratings fall, and again, it doesn't matter. I'm not speaking in particular to any presidential administration. I'm just saying in general, what you see is Congress wants to put some gap between that, and that gives some power to those on the fence that are teetering to go back to whatever their original view was. And so now all of a sudden we see that. He says, instead of rushing to spend trillions on new government programs and additional stimulus funding, Congress should hit a strategic pause on the budget reconciliation legislation. And somewhere down here, he said, I, for one, won't support a $3.5 trillion bill or anywhere near that level of additional spending without greater clarity about why Congress chooses to ignore, the serious effects of inflation and debt that have on existing government programs. Once again, we have what I've been talking about is when government agencies cook the books, sometimes there's a negative policy response. And what we're seeing here now is a key person in Congress, Manchin, swaying the other way based on data that we know may or may not be correct. You know, you have the 10 million of employment, you have these big numbers from the BLS, and you have the CPI numbers, and all of a sudden, all that together starts dictating policy. Whether you agree or disagree doesn't matter. I just want to bring that to your attention. All right, now, what does that have to do with treasuries? Well, this is interesting. We see this from Reuters. Investors have swept into assets perceived to perform on slowing growth and rising inflation. So investors are believing the inflation story, according to a weekly roundup by BofA showed on Friday, with tech stocks seeing the biggest inflows and large outflows from government debt. We then go over to this chart on IEF, which is the largest exchange-traded fund that purchased 7 to 10-year U.S. Treasuries, and it saw nearly $1 billion of outflow yesterday. And it's one of the largest moves, well, since the big sell-off in February. So if we look at this from a chart, which I have here, what you see then is here's this February move down, and you see almost no move in a very small move in prices. My friends, that there, what you saw is the power of QE, in effect, the power of QE slowing down these sales, because what is $1 billion to the Fed? In QE, it's nothing. It's absolutely nothing at all. All right, let's continue on with the data. We'll get the screen back where it needs to be. We have the ISM services. We have to talk about that. Let's see what happened else. Is there anything else today of real importance? No, we need to get into the ISM services, because there's also a hint here that we see signs that there isn't going to be strong hirings going into the next month's payroll report, because the services PMI, let's look at this, expanded at a slightly slower rate, went from 64.1 to 61.7. Still a decent number by a long shot. 61 is a great number, but look at the trend. Business activity slowed. New orders virtually unchanged. Employment unchanged at 53.7. Let's go down to employment. So what that's telling you is there's a slight growth in demand for services employment, but not much. So here you see July, there was slight growth. Here we have August, slight growth. What it's telling you is the actual amount of people being hired or likely to be hired to show up in the next report, not a whole lot. So very important to understand why these survey data, the survey reports are important. Supplier deliveries are slowing, inventories are falling, prices paid falling. So we're seeing, the price increases are slowing, backlog of orders slowing. So what is it telling you in the services sector overall? Demand for services is indeed slowing down. All right, let's take a look as we kind of wrap up today's show. This from our friend Stefan at Skyway Asset Management. We'll get the latest data from him perhaps over the weekend. And this is the speculative positioning in TLT, or not in TLT, in Treasury futures, and he's got TLT charting up here. And what he has said before in conversations with me is that when you see people go long the bond and then flip to short, he says that is where you get a beginning of a massive rally. So in his book, you're seeing this longs, total positioning, futures and options going short and pushing that into the long range. What is the other perhaps driver on the move in treasuries, other than the fact that there was a large amount of selling today that perhaps just flowed into the markets in this overnight? Well, what you have is the fact that algorithms, computer algorithms, believe that tapering the balance sheet, reducing the asset purchase is bullish for treasuries. Now, some people have commented on Twitter is, well, wait a minute, these programs are only as good as the people writing the code. Unless you have an autonomous program that's out reading all the news and information and on the internet, and where you have expert after expert and pundits and everybody saying that tapering is bullish for treasury. So what does the algorithm believe? Well, it must be bullish. So when you get a payroll report that says, hey, there's probably not going to taper, what are their immediate reaction? Sell bonds. Now, we do know for a fact, because we've studied the 1940s, and we understand how QE works, that continuation of QE is bullish for bonds. But it doesn't mean these algorithms in the pre-markets, when there's very little trading, can't drive the tape down. And what did we see today, which we'll talk about on the Sunday chart show, is there was a lot of, all that selling, and there was a lot of it, was absorbed by buyers. Let's go back. We got one more chart from Stefan, and he says here, this is the S&P information technology sector reaches dot-com bubble peak, and as a point where people are dying to still, as we just saw from Reuters, selling bonds and moving into tech stocks that are just at their all-time highs, going higher, but from a valuation perspective, are massively overvalued. And so, my friends, why did we hang out at the castle walls? Well, we had to defend a little bit today. The horses got a little spooked, but they're coming back on the track. We'll show you that on the Sunday night chart show. And if not, we'll see you back on Monday for this show. And yes, even though it's a U.S. holiday, we've still got a show planned for you. I'm Steve Van Metre. Thanks for watching. For those in the U.S., have a great long weekend, and I will see you soon. Thanks for watching. Bye now. The content of this video is provides educational information only, is not intended to provide investor or other advice. It shows not to be construed as a recommendation or solicitation by a security, financial instrument, or participate in particular trading strategies. Videos prepared by Steven Van Metre, personal capacity. Opinions expressed in this video that I do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.